Before we continue our talk with regard to closing the books, I would like to remind you that we are walking along, so to speak, our accounting cycle. So we started with analysis of business transactions, then journalize them, post, and prepare a trial balance. This is almost a groupings: journalize, post, prepare a trial balance. Because then you have to journalize and post adjusting journal entries and, of course, do a trial balance again. Every time you post, you have to double check through a trial balance. After we're done with adjusted trial balance, you prepare financial statements. And then you're going to journalize, post, closing journal entries. And of course, just as I said, anytime you post, you have to prepare a trial balance. In this case, it's called post-closing trial balance. When I was a student, I always thought that preparation of financial statements is that grandiose step that has to be at the very end. Now, the problem is, as you just learned during the closing, we will zero out or close out our temporary accounts such as revenues, expenses, and drawings. So if you try to prepare financial statements and income statement to be exact, it's going to look no more than a whole bunch of zeros. So during the question on the accounting cycle, always remember that you prepare financial statements from the adjusted trial balance, and it cannot be this step of preparation of financial statements cannot be the very last one. Your last one is post-closing trial balance. What does it look like? It is the shortest out of all the trial balances. Why is that? Because all the temporary accounts have zero balances. So if you carefully look at these, all these accounts appear in your balance sheet. So these are all so-called balance sheet accounts. Okay, now I'm ready to talk to you about classified balance sheet. So you know that balance sheet as a snapshot at a time. So you took a picture and you have one date. And in order to improve understanding, companies group similar assets and similar liabilities together. In addition, we also have ratios that we calculate based on those groupings. So these are major groupings or categories that you're most likely to see on any of the balance. Okay, let's take a look at, just brief look at what they look like or what they contain. So first of all, I want to show you that they could be 3 columns. And why is that? These are no more than subtotals. It's not debits and credits. Otherwise, how did we end up with 3? So for example, for equipment less accumulated depreciation, your first subtotal, that's also called book value, will be moved over to the other potential subtotals within property, plant, and equipment right here. And then we've got long-term investments again, and then current assets. And then we have 3 large, well, in this case, 4 large groupings with intangibles that add up to your total asset. And here's your liabilities and owner's equity. So let's take a closer look. Okay, so what are current assets? Current assets are matched with current liabilities. So assets that the company expects to convert to cash or use up within 1 year or the operating cycle, whichever is longer. What is an operating cycle? It's the time it takes for the company. So for example, I gave you an example of service company to go from cash all the way through to hopefully larger cash. So we invested cash, performed services. If we charge it on account, then hopefully we're going to receive a larger cash. If you want to compare it to the operating cycle of a merchandising company, there's one extra step right here is inventory. So operating cycle of a service company is shorter than of a merchandiser. So again, that's the operating cycle. Majority of companies' operating cycles are shorter than 1 year. That's why current liabilities and current assets, usually the cutoff is that 1 year. Okay, so what will be a very common, so if you'll see them here, these are very common categories of current assets. Again, we either convert them to cash or use them up within 1 year. And they're usually listed in the order of their liquidity or in which they expected to convert them to cash. How liquid, how fast can I convert them to cash? Cash and cash equivalents go always first. We talk about cash equivalents in chapter 8, so you learn what those are. Short-term investments, they must mature within 1 year to be listed as short-term investments. Receivables are always current. Inventories, of course, we hope to sell our inventory within 1 year. You have prepaids. One that could be listed here is supplies as well, also always current. And then you can have other current assets that you'll most likely learn in intermediate accounting. Okay, long-term investments, opposites of short-term. So they have to be maturing after 1 year. Okay, and it could be, it's not just stocks and bonds, it could be other assets such as land, buildings, could be any asset. Now your big item to watch out for is they cannot be currently used in operating activities. So if you bought a parcel of land and you don't have your operations, you're not using that land, you just bought it because you thought the price is going to go up and then you're going to sell it. That's a perfect example of an investment. How about next one? Property, plant, and equipment, or PPE for short, or sometimes they also call fixed assets. That's chapter 10 in our book. These are assets that have physical substance to them, and we use them for longer than 1 year. Typical examples are your land, building, machinery, equipment, furniture. And we talked about depreciation and accumulated depreciation, what those are, and again, more in chapter 10 on those. Okay, intangible assets. You have no idea yet what those are. Still, again, in chapter 10, we'll discuss more. They're long-lived assets that do not have physical substance, and you have quite a few examples of those. For example, you have franchise, copyrights, you have licensed trademarks, and goodwill. In one of the classes, I discussed goodwill in greater detail for you guys. How about liabilities? So again, current assets and current liabilities. Typically, we're trying to match, or we're shooting so we don't have more current liabilities amount-wise as compared to current assets. Otherwise, we cannot meet our obligations that easily. Usually, we put notes payable first and then accounts payable, and other items go by the order of their magnitude, how large they are. Common examples, you know, the liabilities: accounts payable, salaries, wages payable, notes payable, interest payable, income tax payable. They're all payables. Now, the one you have not seen before is current maturities of long-term debt. So what does that mean? So, for example, your mom and dad might have a mortgage payable. It's a 30-year mortgage. However, when we pay mortgage every month, we pay not only interest, but we pay a small portion of principal that we borrowed. So within the upcoming year, we have 1 year or 12 months worth of principal payments that are due. So those will be called current maturities of long-term debt. For example, I owe $100,000 to the bank, and just for simplicity purposes, I will be paying off every month $1,000. So within the upcoming year, I will owe $12,000 as far as current maturities of long-term debt, and then the remainder, $88,000, will be listed as my mortgage payable. So between 12 current and 88 long-term, I have my full amount of $100,000 that I owe to the bank. Okay. And here they are, listed up nicely, all the current liabilities. As far as long terms, these are pretty popular. Bonds payable, notes payable, again, if their due date is after 1 year. Now, be careful. Sometimes students have years confused, okay? So, for example, let me grab a pen. If I have this balance sheet dated as of 12/31, let's say year 20, okay, and these are long-term liabilities, so that means anything within, okay, the upcoming year of 2021 will be considered current. So if I have a note payable with a due date of March 6th, 21, that's current because it's due within the upcoming year. Students usually think, well, it's got to be due within year 2020. Well, if right now is 12/31/20 and it's due within 2020, by now it's past due. It's way too late. So all these have to be, because they're long term, after 12/31/2021. Okay? So it doesn't make sense. Again, after, so their due date is after 12/31/21. And the full year of 2021 will be listed as current liabilities based on their maturity date. And here's the last slide, owner's equity. So in our textbook, we mostly deal with proprietorship, where we just have one capital account. With a partnership, you will list capital account for each of the partner. For example, Jake's capital, Nadia's capital, Randy's capital, etc. And then for the corporation, instead of capital accounts, we divide their capital into common stock or capital stock. Okay, it should say better will be capital stock as opposed to common, because we have common and preferred. And the other part, so these are the investments that were done by the people. The other part is retained earnings, earnings of the company or net incomes and losses that were retained. Why retained? Not given away as dividends back to the shareholders. So instead of drawings, we have dividends that corporations could give out to their owners. So here is an example of Nordstrom, and they have stockholders, so you can look, it's plural because it's a corporation, and you have common stock, and then also retained earnings, the amount of retained earnings. That's it for chapter 4.